Hi, everyone. Welcome to the TimingResearch.com crowd forecast news for February 14th, 2022. We are recording this at 1 p.m. Eastern Time, and this is the 331st episode. So today, we're going to have a special option professor solo episode where he's going to talk about his market outlook, and you should be seeing his screen right now. So I'm going to go ahead and turn it over to him.
Okay, thanks a lot, David, and welcome everybody. Nice to have you here. A quick introduction, the option professor. We've been around for quite a long time. I've been in the investment arena for many decades. We've done hundreds and hundreds of seminars for many thousands and thousands of people across the entire nation, educating them on the uses and risks of options and other investments as well. And, basically, I'm a graduate of Boston College, and I've had extensive training. So again, I also work with my own funds, and basically I'm going to give you today my best opinions and observations on what's going on in the markets. And again, anything to do with advice has to come from yourself and has to come from your brokerage firm and your broker who know your circumstances, not us. So basically, we're going to give you ideas and our opinions, but we're not giving any advice because obviously we don't know you. With regards to what I'm going to cover here today, the option professor has 5 PDF reports. And the reason we went that way is after decades of watching the landscape of education in the markets. I mean, I look at TV sometimes and I just start laughing. Some of the firms that give educational information, they refer to these gains that might be 1,000% or 1,500% or tremendously better than this index or that index. And then they cite things like buying Google at the bottom and Microsoft at the bottom. And the reason that's laughable is that is like talking to Marty McFly of Back to the Future. You're not going to get those returns from the guy who bought Google at $10 or bought Microsoft at 15 or guy. So, I mean, even mentioning them is silly. So, I think there's some problem with that type of an approach. And then, of course, it starts with a cheap amount in. And then if you want, they'll give you maybe stocks that are so well known, everybody knows them. And then to get more intricate, you've got to put up a tremendously larger amount. And then there's others who are into growth. And they may mention that their earnings are doing good on their growth stocks. I mean, the fourth quarter was good for growth stock earnings, but some of these stocks are down 30 and 50%. So if they bump a little bit, that's certainly not going to help you very much if they're already down 50 or 70 or 30%. So the bottom line is we believe that there should be a little bit more clarity and a little bit more, shall we say, balance to when you are spoken to about this education stuff, And so these 5 PDF reports that we've come up are involved in the real world. And in the real world, you're either making money or you're losing money, right? And so basically, there are things you do with your money, even if you don't know that's what you're doing. This is what you are doing when you invest. You're either trying to get income, and there you're probably going into the debt market, or you're going to go into a high dividend paying situation. Then you're going to try to get growth. And that means you're probably going to tech or some type of innovation or some type of industry that might be growing quite a bit. Could be the energy coming out of a bad number. And value, which means these companies have free cash flow so they can pay you dividends and their PE ratios are quite a bit lower. That's how you get money to grow that way, growth or value. Then, of course, you can turn over overseas. We're the globe, we go get a globe. There's a lot of people out there who don't live in the United States, a lot of companies who don't live in the United States, are not domiciled here. So obviously, Japan, Korea, China, Australia, Europe, Latin America, Brazil, Mexico, these people have economies, they have companies making and losing money. And so international investing is something else that is on the docket if you're trying to make some money. And then, of course, you've got speculation, which is, Bitcoin may go up, Bitcoin may go down, silver and gold may go up, silver and gold may go down, soybeans may go up, soybeans may go down. Or even some of the stocks that have no earnings, they're speculative. Okay. I don't know what anyone else is telling you, but that's the truth. So that is the fourth area. And then the fifth area is we have some techniques for protecting yourself, hedging yourself against market declines. And of course, that comes in very handy. I mean, ask anybody who owns Facebook. I'll show you Facebook as an example. I mean, there's, there are billions and billions of money lost there. And there were ways for you to stay in the market with Facebook, but also protect your equity from market declines. So the bottom line is we're going to cover stuff from an angle of a guy who's been doing it for decades, who's trying to stick with, making or losing money, not, the second half of the year is going to be tremendous. Who knows that? I mean, how, of course it may be, because the first half stinks, but the bottom line is there's no assurance of that. And so the bottom line is, and then the interest rates are going to stay between 2 and 2.25 on the 10-year. Nobody knows that. I mean, and inflation's going to roll over and subside. Nobody knows that. So the bottom line is you try to, in our view, in our opinion, we try to look at the charts, we try to look at the moving averages, we try to look at the relative strength of the market and work off what the reality of the numbers are. Because otherwise you're chasing different headlines, you're chasing different talking heads, and that is a rough racket. Somebody who says buy all the time, on a market that 80% of the time will rise, probably will come out okay. But that 20% that it doesn't, can be a very, shall we say, disturbing situation. So the bottom line, and some people are working on a very short time frame. So the fact that they're right in 4 months could wipe you out in the short run if your time horizon and trading strategies are shorter term. So the bottom line is we're going to work with our opinion and our observations, and our PDF reports reflect that. And what we did in those PDF reports is we tried to be realistic. All right. And so I'll start out now and give you a little bit about what we're talking about. Let's start out with the ballpark on what's going on in the market. We've been telling people that 4,400 on the S&P is a very important area for it to hold. Today, we went underneath it, 4,385. We have turnaround Tuesday possibly coming up tomorrow, and we also are now trading above it. So let's see how they take it home, and let's see what happens on turnaround Tuesday tomorrow. Now, the other thing happening today is the Fed is having some kind of a closed door meeting. And some people are speculating that when they come out of that meeting, they're going to say they're not going to do any hiking until the March meeting, despite the fact that anybody who has a brain can see that they're way behind the curve, because 7% and 8% inflation and still buying bonds is stupid, right? And so the bottom line is that they're putting a whole bunch of weight on things are going to slow down naturally, and whether or not that happens is going to really be the key to the second half as well, and the rest of the first half. There are those who think we're going to have a very strong ending to the month of February, and they may be right, because we are in an oversold condition. And as we go into the Fed meeting in March, remember that the 2-year is already way above 150, so it's already priced in 6 hikes. So you ever heard of the worry, buy the rumor, sell the fact? Well, this could easily be sell the rumor and buy the fact. So let's take a look and see what happens. We also have a PPI number coming out tomorrow. And of course, the energy sector of that is going to be very interesting, because the energy prices were actually showing down in January, according to the CPI report, which seems like a joke, because obviously we're at 94 on crude. West Texas. So anyway, the PPI report tomorrow is going to have some effect as well. So I have to keep an eye on that. But if this PPI breaks decently and the Fed comes out and says they're not going to do any hiking, until March, and they're not worried at all, then that could give the end of the month relief rally that people are talking about. And if you look at the chart here, my 12 SMA on the 20-year comes right in where? Right in at 44. Well, it's at 43.96 right now. Okay, so it's right at that 4,400 number. We went underneath it today by $10. Obviously, that could have just been running the stops. We'll have to see. And the VIX, something obviously after decades of doing options, I would be familiar with, right? Well, the VIX today went to 32, but now it's backed off into the 28s. If you're bullish, you got 2 things going for you. you have got a situation where the VIX hit 39 and we haven't taken that out. And the S&P hit 4220 and that hasn't been taken out. So as long as those two numbers are intact, the idea of a collapse down, again, we've been telling people this is a year of reversion to the mean. So can you see on the 20-year graph, we've reverted down to the first level of the mean. If we break this level, that means we take out 4,200 because things do slow down and the Fed does have to hike more aggressively. And we take out this level. First level to take out now is around the 4,400. Then after that, 4,200. And then it opens up the window for 38 and 3,500, as you can see here, or 3,600 ballpark. Okay. That would be a full reversion towards the mean, like it did down here in 2011, like it did here in 2016, like it did here in 2018, and of course, during the crash of 2020. Sometimes it reverts totally back towards the mean. If you notice though, if it does get underneath the mean there, when it goes back above it, you definitely want to get back on the horse because this is a washout. And when it's done washing out, that means they've done something to correct the situation. And that's why we let the numbers do the talking. That's why we're not buying up here at 4,800 because we know it's extended and we know the Fed's going to be hiking because you can't have zero rates and 7 and 8% inflation forever. And again, your house can't go up 30% a year ad infinitum. Okay, so the bottom line is that's why we are looking at reversion to the mean. Okay, if we go to the 5-year graph, you'll see another number that is very important is getting back above. Right now, getting back above 4,500, 4,552, and back above 4,572. Okay. The problem here, and the thing that's scary, is the 12 SMA, when it starts trending down, is not good. That means if you notice, since we started this move here, back in, well, it jumped above the line at 2,800. So this thing gave you a buy signal at 2,800. And although it got penetrated a couple of times, can you see it never really turned down the entire run? Well, it has turned down now, hadn't it? And that's not a good sign. So that's why being under 4,600, being under 4,550, being under 45 even. And if we start getting under 4,400, and this thing is trending down and your RSI is hanging on for dear life here. The RSI is at 53. That you got to be careful and you got to know what your plan B is. That's why some of the hedging techniques can be very helpful for people. Okay. All right. So let's, that gives you a little idea. And then on the 1-year graph, nothing really good here. Like I say, 4,500 is going to be an area where you'd like it to see it above. And that's one of the other numbers on our chart. And again, getting above 4,600 is another one, but that blue line is definitely coming down. And when the moving average is pointing down on these things, it's not a good thing. Okay. So you've got numbers to work with. 4,600, you got numbers to work with, 4,550 and 4,500. And now you've got 4,400. And that's the one right now we're holding on to. If we bust, then of course, you know, it might be on news. And if it's on the kind of news that this stuff, you know, is going to react to, and don't forget your RSI here is under 50 on the daily. So if we get to see the RSI at 40 is very key on the daily. If you break under 40 on the RSI, that's when you can get an acceleration to the upside. Just like if it breaks above 60 on the RSI, it can give you the acceleration on the upside. Okay. So that gives you some parameters to work with on it. And let's start going through what we cover on these PDFs, which is what people do with their money, right? Now, TLT is a proxy for the 20-year treasury. Okay, it gave you a sell signal up here at around 149, 150. It's way down here now. Okay, that's oversold. That's oversold. Doesn't mean it has to go up, but certainly it's oversold. And if you look at the other ones, which is the 5-year graph again. So interest yields are in a rising mode right now, and all these moving averages are crossing. So could we get a bounce back rally if something happens between now and the end of the month? It's possible, because it's in a little bit of an oversold condition. Where's the RSI right now? It's at 40. That's why I tell you, if it goes under 40, we could accelerate to the downside. Okay, so that's why this is very key right now. On the 20-year going back, now this thing is still rising, so that's a good thing. The only way this thing gets back above the blue line, though, would be if something bad happens to the economy or the stock market and people rush back into bonds, because they are yielding more than they were. Don't forget, this is the high. That means that's the low in yield. So the yields have been rising. Now, like I say, income is one of the ways people try to make money. Well, if you're in bonds, you're losing money. Okay. And you're in muni bonds, your equity is dropping. Okay. And that's, no matter what they tell you, oh, they come due at some point, God bless you. If you're in a 30-year and you're on the Pritikin diet, maybe that's a good thing for you. But the bottom line is that a lot of people don't want to be holding on to things that go down every month. Okay. So that's the problem. So if this thing starts taking out 136, it opens the door for an acceleration to the downside. And again, the red line being in a downdraft here is not good, because these other ones will catch up over time the longer it's underneath here. See, the longer it's underneath 140, that green one's coming down. That blue one will flatten out. So this thing continuing to be weak is not going to be good for the trend. Okay. So let me give you an idea of some things that people are in that, that are for income. Let's look at high yield. And here's why we haven't been suggesting that. Last year, okay. But this thing here is breaking down on high yield. Okay, that's breaking down. Where's your RSI right now? Your RSI is at 44. If RSI gets underneath 40, this could accelerate to the downside. If not, it could stabilize. Okay, but at any rate, it's not something that I would be expecting to make money on. This is another one. It gave you the sell signal up here at 87.88. Now we're at 82. It's oversold. I give it that much. Where's the RSI? 36. Again, once it broke 40, which is when it broke 40 on the RSI, way up here at what? It broke 40 way up here at 86. So do you understand what I'm talking about? When it breaks 40, which it did up here, it could accelerate to the downside. And now it's at 36. Okay. So this is high yield. So can you see high yields in a tough place? What's the other way they try to make money? They try to make money on municipal bonds. And listen, I'll get to all the markets. So if this is not your cup of tea, God bless you. Hang in there. I'm going to get to them all. But when I got money, there's different things I can do with it, right? And the first thing you can do is try to make some income on it. And this is the kind of stuff they buy. Okay. So anyway, does this look like something you want to own? No. So again, this is a tax freeze. Now, like I say, once, you can hold on to these things until they come due. And if the guy who issued them pays you, is good for the money, you're going to get your principal back, and you'll get your principal and interest, and you'll be okay. That's the difference between a debt instrument and stock. If you bought Facebook up at 330, there is no assurance you're ever going to get your money back. If you buy a bond and they tank on you, if you hold it until they mature and the issuer, is good for the money, then you'll get your principal back and you will have collected the payments as long as the issuer made the payments. Okay. All right. So there you go. Munis don't look like they're working out so well either. Again, they are oversold. So you got high yield doesn't look so good. And then now it looks like preferred stock. You ever heard of those? Those are issued a lot of times by banks, but they are a senior security. But they also are not something that when you go to your statement has been giving you any money. So what am I saying here? I don't know what people are saying out there, but if you're in fixed income, your equities is dropping. Okay. So where in fixed income is it not dropping? Doesn't that sound like a good question? There it is. And one thing that has been doing very good. Now, again, this is a different risk parameter than the other ones I'm talking about, but I'm just talking about things that have been stable in this environment. And this is one of them. It's called the floating rate high income. This is by Fidelity. Of course, I'm not recommending this. You would look at it, you would see if it's for you, you talk to your broker, and you do all the 9 yards of due diligence, and then you make your own decision. But this is something that I've brought to people's attention because this is short duration and it is a floating rate, which means the rate changes as rates change. And again, does this look a little more stable than the other ones? That's one of the reasons why people get the PDF file that we have on income, because we have certain product knowledge about it after decades of doing it. And we are not, we're not, shall we say, we're not a muni bond salesman. I don't have to tell you to buy uni bonds or something like that. We're not the high yield debt salesman, so we don't have to tell you to buy that. We're looking for where it appears to be a relatively stable environment while other environments are very unstable. So again, cash is another alternative. People say cash is trash. Let me tell you, it ain't trash lately. If you were in cash rather than those bonds, do you think your P&L, your profit and loss, your daily statement would look better? Of course it would. But you've got these people on TV and radio and newspapers talking about how cash is trash. I'm telling you right now, sometimes it's not trash. And in the last 2 to 3, 4 months, it's been gold. Okay. If this was your alternative. Okay. So anyway, that's why people get the PDF file. There's a whole lot more in it as far as trying to get income. But this gives you an example of how we look to where the environment seems suitable for the environment we're in, and we try to stay away from the environment that is deteriorating. Okay, now, and again, the environment's changed, so obviously we can change our opinion, but we're not going to change it right now. We do have a suspicion, and that's all it is, that there's potential that we are getting very oversold in the debt market because we've gone on that 2-year from like 0.5% all the way up to 160 or something like that in a very short time. And so if the Fed is going to go at 1/4 point increments, maybe again, the 2-year has discounted about 6 hikes. So maybe you could get yields backing off a little bit as we go into March on a what? Sell the rumor and buy the fact type situation. Okay. All right. The next area people try to make money in is in growth. And again, when people try to get growth, they look to things like tech. And of course, in tech, that would be the QQQs. So let's take a look at the Qs and see what they're telling us. We like to let the market tell us what's going on as opposed to us listening to somebody or just holding on to hope or any of that other stuff. Okay, so here you go. On a 20-year basis, again, if we are going to break, this was reversion to the mean. That's the whole story this year, right? Reversion to the mean. Everything else is just conversation. So you've come back to the first level, and that comes in at 361. Okay. And the next level, if we break here, and we are trading under 361, so obviously that's a risk. Now, if we do close under here, a big reversion to the mean would be something down here. Now, there's some Elliott wave theorists and cycle people, 20 and 40-year cycle, that believe that we are going down to these levels here later this year or sometime this year. So there is a risk of this occurring. The scenario would be pretty simple. The inflation doesn't back off. The Fed hikes a lot more than people think. The earnings start drying up. And then you got Tom, Dick, and Harry, who's all in the stock market, want to come out at the same time. Okay, that's how you get down to those other levels. We're not there now, but you got to at least give it some credence. People who don't respect the other side of the coin, sometimes, regret that. Because every pancake has 2 sides, right? So if you're bullish on something, there's a guy out there who doesn't believe that. There you go. So where would we love to see Q get back above? We'd love it to see it get back above 361. It tried to, but it failed. On the 5-year, doesn't look good. And where does it all come in? Anything between 372 and 376, 377. So you got 360 as resistance, and you've got 372 to 377. Okay. And you got your RSI right around 50, but it's under 50. So if this thing starts fading, that would not be a good thing. On the 1-year, the blue line definitely in a downtrend, and that comes in again at the 370. So that's where our numbers kind of coincide, right? We said 361, then we said 372. You can see the number here comes in around 372. You can see these numbers are coming in right around 360. Now, again, this formation could be very interesting. If there is going to be a big rally at the end of the month, let me show you how that happens. You make your one move up to 370. You pull back 60% or so. And now if this thing holds down here underneath the 345 area and we start closing above 360, maybe it takes out 370 on a 1, 2, 3 formation. So there is a little bit of a setup for an end of the year move, end of the month move, but it has got to hold these things here. So right now I'd love to see Qs hold the 345. If you want to trade against that, that's something you could do, but more reasonable would be play it on a break above 360. Then it has some momentum. Then the RSI, which is down at 42, might be breaking 50. And if it does that, then you have a better chance of seeing a rally. But it's a very sloppy looking graph right now in the tech sector. One stock that is coming up with earnings on Wednesday, which is a great company, it's just a question of valuation, is NVIDIA. NVIDIA, again, if it starts breaking above 260, it could really get going. It better hold 340, 240, because if it can, and again, closing above this red line, which is what, 247. So if this thing closes above 247 and then above 260, it could spike to the upside. How's the RSI doing? 46. So again, if it breaks 260, RSI gets back above 50, that would be a good thing for this. And then this red line might not be a bad line to use as a guiding light, which is again, right around 247. Okay. But that has news coming out this week, so that could be interesting. With regards to, so there's your tech, and obviously tech's in trouble because when rates do go up, these deferred earnings, again, have to be discounted a bit, and the valuations have got to be discounted a little bit, and that's one of the big problems you've got. Okay, so that gives you that area there. Again, the semiconductors. Another one where you try to get growth. Again, same formation really as NVIDIA. You've gone up, you come back, you don't want it underneath here, which is what? Right around 263. And then getting back above the red there, which is 275, would be very helpful. So keep an eye on it. If there's going to be a big end of the month rally, you don't have to be the first guy on the train. And again, above this number here would mean that it's possible that things are turning. Okay, so keep an eye on those two things, because if there is a big move at the end of the month that has been touted, well, it's nice to have some proof in the price before you just blindly follow somebody off a cliff. Okay, so there's your growth area right there. You got your semis, you've got your tech. Now, where people are actually getting value is in the value and in the dividends paying stocks, because these guys have got lower PEs and they've got what? They've got free cash flow, because that's how you pay dividends, right? Okay, so they're doing great as far as those things are concerned. With regards to the areas, I'll just give you a couple of ETFs. Now, this is where your account would be more stable than if you were in the other stuff, although this is under pressure now too. But if you look at the 5-year, the 5-year is still hanging in there, but it's barely hanging in there. So again, if this thing starts taking out the neighborhood of, well, let's call it $40, $40.55, starts trading under $40, this thing is in trouble too. But right now, you can see it's been one of the more stable things because everything else has already busted. These things pay dividends. So that's why some people like to use this for income and growth, because they can get some growth out of it. As you can see, that's pretty good growth, $29 up to 40, right? And you get paid a dividend, not bad. The next one is something that is actually a dividend-oriented ETF. And in this one here, again, very stable compared to everything else. So this is where we're parking. You understand the dividends, parking in the dividends, parking in the senior the floating rate loans, parking where they're not going down so much every day. That's why we have the PDF files to explain these things to people, because if you're just running around buying newsletters off TV, that guy made 1,000% off what? Off of Marty McFly's Back to the Future? You're not going to be buying Microsoft for $10. Okay, it's not happening. So why even bring that up? So bottom line is this is what's going on now. All right. And so again, if you want to get some growth and income, value and your dividend payers are not bad. Okay. And of course, the other is your staples. Staples are things that people buy, win, lose, or draw. They've been pretty stable too, as you can see. So again, all the other ones, the stocks are looking like spaghetti coming off of a table. And this stuff here is obviously much more stable. And it pays a dividend. So you're going to get some money while you're watching the movie. Okay. In our growth and value PDF report, we go into specific names and we go into why this makes sense and why this doesn't make sense and when would this make sense. Because again, we don't stick with the same opinion forever. The markets are a breathing, living animal. You got to change your tune, at some point, when the numbers show you to change the tune. We're not dictating to the market what's going on. We're following the bouncing ball. And again, one reason we like to use moving averages and relative strength is to try to A, smooth out the numbers, and B, find out if the patient is, healthy above 50, very healthy above 60, weak under 50, very weak under 40 with the relative strength. That's it. And again, we are patient and wait. That's what you got to do. Okay, next one up is going to be international markets. Okay. Now, there is basically different regions of the world we try to take a look at. Okay. One of the areas of the world is called emerging markets. Now, these things have got nailed because a lot of emerging market has to do with China, but China is just approving something from Pfizer, which is supposed to maybe get this zero tolerance thing off their back. They've got money because they didn't print money like drunken sailors like our Fed did. So they got plenty of money that they didn't print during the crisis that they can now print and ease and alleviate some of their problems. So we look at this thing on a 20-year basis. It looks like it's very good as long as it stays above $46. If we look at it and the RSI on it is above 50 at 53. So it's not extended. It's just firm. Now you look at the 5-year. Again, that's not a good sign. And the RSI is weak. So it might be early for this. Again, we'll have to see it get above 50 and then 52 to open up the rest. You look at the 1-year. And again, there it was trying to get going. So as far as emerging markets, doesn't seem like a rush to get in. Closing above 49 and 50 and getting that RSI back above 50, that would be the first things to look for. But there's a lot of real estate up here if it gets moving. And again, it bottomed here, went up to 50, pulls back, doesn't take out 47, starts taking out 50. Now you're on the bicycle. That's the story on emerging market. Then you look to Europe. When I look at Europe, I am very intrigued by the UK because I've been to Europe many, many times. And every time I'm in England, it seems like they are richer than the other places over in Europe. And they all seem like they're working. So it's a country that seems to be wealthy and working, which is a good combination if you want to buy the stocks, maybe, right? So here's what I'm looking at on the UK. I'm looking at a market that if it got going right now, it could really get going. So as long as we can stay above about $30, it's fairly constructive. And as long as we can stay above $32, again, that's a shorter leash, 32, 33. So you can keep it on a pretty short leash. And if it starts going 36, 38, this thing could really pop. So again, we're starting to see the UK as a reasonable place to look. Again, there's all your numbers on the 5-year. And again, your RSI right now is at 56. We take out 35, maybe it's going someplace. But it looks like something to consider because, again, their valuations seem to be a little bit better than ours, and they are just lifting their things, their COVID mandates. The other area over there, obviously, is a general European situation. Well, one of them we like also would be the banks. These guys are trading price to book way lower than the US banks, okay? And for a reason. They don't have the growth that ours do. But they do look like they're trying to go someplace. And so the bottom line here is these things are turning up. I like to keep it above 20 on the 5-year. Again, if it gets going, you got something cooking there. So those are two markets in Europe. Now let's turn over to Latin America. Brazil is way down, but it looks like it's trying to turn a little bit. Let's see. On the 20-year, if you can get above this number here, which is around 33, 35, the 1-year is starting to get some legs, right? Got a buy signal here to 28. It's already at 32. Look where it came down from. And this is a country that's got a lot of metals that people want and a lot of food that people want. So it's, it's got some stuff going on down there. The other one is Mexico, who is supposed to be benefiting a lot from our reshoring activities and other activities as well. And again, this one on a 20-year basis looks very good. As far as it's looking like it's hanging in there. And again, this thing's down from the 70 area. So there could be some potential there. And on the 5-year, again, staying above the 48 number would be a good sign as well. So you got some international activity out there. And the last one is Korea, Japan, and Australia. Now, these guys, again, have not been doing that great. I think they were hurt also, but it looks like around the 70 number is not a bad one to play it against. And again, it's down from 85. If China, I think that area, the Pacific Rim, probably is affected obviously by China. If China gets better, maybe it'd be better for this group as well. That would be the thinking, right? Because again, you got Korea and you got Japan and you got Australia, and I'm sure they do quite a bit of trading with China. Okay, so you've got that one, but again, this one looks very ugly. This is the 5-year, but it's oversold. So it could easily go back up here and do some testing if things get better. On the 1-year, again, ran right into the wall and it's hanging on for dear life right here. So I'm not saying that international markets look fabulous right now, but I would not dismiss them as part of a portfolio if you're trying to get some growth, especially if you can monitor them to where these trends start turning up. So there's your international markets. We have a PDF file to go over specific areas, specific stock areas. And again, the PDF file in international investing can be very helpful as a reference. Okay. Next area is speculation. And here we basically are into things like oil, metals, agriculture, and then we've got the stocks that have large growth potential, which would be cloud computing, semiconductors, artificial intelligence, cybersecurity, 5G, innovation, EVs, biotech, and then of course, travel and leisure, which could have a very big second half of the year. So those are speculating because again, they can go either way and they're cyclical sometimes, but they seem like they have stories to tell. So let's give you a little bit of an update on some of the things we see there. Also, one last thing is in the speculative PDF report, we go over option trading. And in the option trading, since we obviously been doing it for decades, we go over strategies for a rising market. We go with a neutral sideways, and we go with strategies for a down market. So we show you a number of ways to play with strategies, those three environments. And that's included on the speculation PDF report. But let's go here and give you the stuff that we have been doing in the speculative area, because some of it's been fantastic. Let's start out with energy. We got bullish on energy because when it goes to minus $37 and you see every car on the road needs this stuff, you start thinking that that might be a buy. So that was way back down here. So we've been bullish on XLE, which is basically Chevron and Exxon, for a long time. And up here, obviously, we're a little concerned because we know the words reversion to the mean. And that is, and of course, we're almost at 100 on West Texas Intermediate, and that was the first target. So again, we are extended. If they throw water on Putin or whatever, you know, there's a situation where we could revert down to the mean. So again, this is a place where covered call writing, collars, where you sell out of the money calls and buy puts, might not be the worst thing to think about. Okay. Now, the next one here is on the 20-year graph, which gives you a perspective that there's still room on the upside here, but it is extended and these things haven't even crossed yet. And when they haven't even crossed, look what happened last time. It ran all the way up in 2010, all the way up here, and then they hadn't crossed yet, and you got a big drop, and that big drop was a buy because then they all crossed. So if we do get a pullback and then these all cross, be a heck of a time to buy in, possibly. Okay, on the 5-year graph, there you go, you've seen it. And again, remember I told you about that? If the RSI gets above 60, it can accelerate. Well, let's take a look at when that happened. Okay, so, well, down here, RSI was 47, RSI goes to 60 right around here. And it gives you a nice pop up to here. And here the RSI is at 60 at right around 55 or so, and it gave you a pop all the way to here. So you understand we use the RSI because it gives us an idea of an acceleration as well as a deceleration if it goes the other way. Because watch this. Once the RSI dropped under 40, which is right here, you could accelerate to the downside. Okay, so these are some of the things we've observed after decades of watching these things, right? And we don't refer to some stock you could have bought at what? At 11, that's now at 2000. No, that's not what you do. All right, so let's get to the other stuff here. The other ones that we are kind of looking at, just to give you a little idea, you know, if we need oil, they're going to have to drill. If they need to drill, they need drill bits. If you need drill bits, you use this company here, Schlumberger. So again, we've been bullish on this thing ever since here. It's been going up and back and up and back. Now it's up. Maybe it pulls back, but look at the real estate up here. A lot of potential. Okay, there's a couple of other ones we have in the report that would be very helpful to know as well. Okay, so energy is one. After energy, let's look at these metals. This is something that I have been very much thinking was a good idea for a while, and you'll see why. You go to the 20-year graph here, and it has been going up ever since 35. When it pulled back here, okay, what's the low here? 52. Anywhere between 52 and 55, I thought it was a bargain using this blue line as a get out point. And it was also paying 4% dividend. Now you're trying to tell me that buying into this thing that used to be 75 when it's down around 50 and getting 4% with a rising moving average is a bad deal? I say no, I think it's a very good deal. And that's why I thought it was good. Okay, and I told people that. All right, now it's now looking like as long as it stays above 60, you're in good shape. Gold prices are trying to break through this 1870. It still may not do it. Okay. But if it does, and we go to 1900, it could go to 2000 fast, it can go to 2100 fast if it can break out. But for the last year, it's been trading between 1900 and 1700, and everybody who's bought strength are unhappy. Everybody who sold weakness are unhappy because it's chopped you up. But again, been doing this for decades. I mean, you tell me 7-8% on inflation, and you tell me interest in the bank is at 0. I'm wondering why gold's not at 2100. So the bottom line is that, it's not done it yet, but I would monitor it. And the only thing that would make any sense is, if this rate hikes get aggressive and if deflation comes into the system, and that would make, and the dollar got extremely strong, then, then the gold could break. But the way they are playing games with the, quarter of a point here, quarter of a point there, my history on this stuff, that, if you told Paul Volcker inflation's at 10%, let's do quarter point hikes, he would have laughed you out of the room. So we'll have to see how it goes. It's a different world out there. I get all that. They always tell me that right before it's the same world. But the bottom line is there's a tremendous amount of debt out there. And that's the biggest, scariest thing out there. And that's why everyone says they can't raise rates because the debt is so high. Hey, listen, they've said that many times in history that they can't do this because of that. We can't come out of a crash in March because no one will buy these bonds, right? When we had the crash in March of 2020. Well, did you know that the Fed could set up 14 facilities, print money, and fund those facilities to buy mortgages and bonds that they generally would never buy? No, you didn't know that. So anything can happen when it has to happen. That's one thing I've learned. But again, like I say, this is very interesting to us. Another one in a speculative area is copper. Again, I've been involved with this stock here since it was $10. You'll see why. I mean, it broke above 10 right here, 10, then 15, and it was off to the raises. Now, again, it's way up here. Is it going to have a more severe reversion to the mean? If they break the stock market, it will. Because if they break the stock market, that means they broke the economy a bit. If they break the economy a bit, then copper won't be going up anymore. So copper and the economy, I think, are pretty tied. Then you've got these industrial metals. Cleveland Cliffs. Again, if this thing can get going, there is nothing but real estate above, right? And there you go. We want it above $21. Starts getting above $21, then you're going to set your sight on going someplace. The other one we like is this company. I always call it Vale because I'm not Portuguese, but I think it's Vale. And Vale is something that we started biting on at 14. Does it look like could it go? Well, there's plenty of real estate above if it wants to. And again, this is a tangible asset with not unlimited supplies. And if the economies of the world do well, they need this stuff. And when they need it and they can't get it, they pay up, right? So there's a couple of areas there in the metals and also in energy, which are two right off the bat. Another one, a couple of other ones we're keeping an eye on would be 5G. And hang on a second here. Well, in addition to that, so I can keep the ball rolling here, cybersecurity is another one to keep an eye on. Obviously, everyone's hacking into everyone's computer, so people need security. And here is a cybersecurity ETF. Obviously, we have individual ones we like as well, but yeah, there you go on cybersecurity. And let me go back and get this thing to where it gets my averages back up there. And let's go put those up with the averages so you can see the annotations. The annotations give us an idea of the trend. This hadn't been around that long, so we go to the 5-year graph. And as you can see, if it can get above 50 and resume its uptrend, we will have a lot of interest. If not, stand aside. The other one here is the 5-serve. Well, I'm gonna keep going because I don't want to get hung up on it. Another one that people like is the ARC funds to get all the innovations. It's hard to get excited about these guys because obviously they've been losing money and losing money and losing money. But again, they're very oversold down here. Doesn't mean it has to pop. The low has been 64. It's trading 71. Again, the RSI is very low here at 36. On your 1 year graph, it's just hard to get excited about this stuff down here because again, higher interest rates really hurts these guys because of their stuff being innovative. Here's the area that might be very exciting. And this is something that we have definitely been telling people to get involved. So MGM is for your hotels, and basically if you look at the 20-year graph on MGM, you are looking at a stock that as long as it stays, and this is again, if there's not going to be a reversion to the lower mean, we want it to stay above 42 bucks. If you like it here, you definitely want it to stay above 43, 42. Let's call it 44. So 43, 44 right here. We want it to stay above. Starts breaking underneath that, something's wrong. And then on the 1 year basis, again, numbers all come in around the same, 43, 44. So as long as we can stay above 43, 44, looking pretty good. Next one is jets. They have to get there, right? How are you going to get there? You're going to take a jet. And when you take a jet, you are going to take one of these jets. And so as long as we're above 2150, that's good for us. And we would love to have it close above this number, which is around 2250. And then even better would be to get above 2350. So let's stay above 2150. Let's get above 2250, and then let's get above 2350, and then we can get moving. Okay, so keep an eye on jets. And after you stay there, you fly there, you are going to possibly need to get a boat. And that's when we take the Carnival cruise. And so on the Carnival cruise, again, you can see you'd like it to stay above 21 bucks. On a 5 year, you'd like to see it get above 24 bucks. And on a 20-year basis, you would like to see it basically get above this 25 bucks and then start getting above 30. So if there's going to be a big move back up here, you're going to probably hold these lows, which is what? 16 bucks. Then you're going to get above this number here, which is what? 20. What do you got? 23 bucks. 23, 24 bucks. Okay. And then you're going to get above 30 bucks. And then of course up here. So then watch this closely. If we're going to have a big travel deal in the second half of the year, and again, these people are acting like we are, because this is Expedia, something we got very positive on after it dropped. You see this big drop from 190 down to 140? That was the buy. Great buy, because you got this stuff rising, right? Now, again, it's getting away from itself, so there could be a pullback towards the mean. But this is telling us that somebody is planning on going someplace the spring and summer. So that's why we're keeping a look on that. For what? For a speculative move to the upside, with plenty of potential. Last one I'm going to show you here are two things in medical area. One is biotech. Now, we want this thing to get above, and I'm watching this like a hawk, 133.63. We want it to get above that number. It tried to, but couldn't close there. And the RSI is right at 49.50. So this could be a fantastic place to do it if it can get legs and stick a little bit, okay? Because this chart here is telling me that this area here should be about it, or else the whole party's over as far as, I mean, you start trading at 110 or 100, I mean, something's going on, right? The other one is in your area of pharmaceuticals. This is another one that, as long as it can stay above these numbers here, might be worthwhile. But here's the other one. A lot of people have not gotten these operations because of what? Because they can't get into the hospital with COVID. So if they start doing better here, getting people in to these operations, then the medical devices could start going. And so a close above 61.62 here would get me very interested, because again, it could indicate that that the things people were putting off, a knee, a shoulder, or whatever they do, could, a hip, they could, these devices could come back in. So keeping an eye on that as well. You've got your EVs, of course, and you've got it. Well, I can't go over everything that's in this report, but there's a lot in there. So that's the PDF report on speculation. That one is 9 pages long, and that one I think brings a lot to you. Now, one last thing real quick before I got to sign off, and that's going to be on Facebook. And what the last one, the one on hedging, makes most sense. And that is this. Facebook was trading at 380, right? And it was way away from its moving average. So you could have been saying it's going to revert back to the mean. So when it's up at 380, even if you did it here at 340, when it clearly was rolling over, right? Even 340, never mind 380, 340. If you see something like this, what you can do is either get out or you could hedge. How would you hedge this? Well, if you're up here at 380, what do you think the 340 puts are going for 6 months out? Probably not that much. And if you're up here at 340, the puts might already be getting expensive because you had a drop. So here's where you'd look for the collar. You sell the 360 call, ballpark explanation. This is a ballpark example. This is not and then you buy a put at say 320. So you're selling the call up here and you're buying the put down here, or you're buying the put at 300. At least you have parameters around your equity. When it drops down to 216, you've got the right to sell at 300 or 320, which you've protected $100 of risk there. $100 of risk is a lot of risk. And you would have used the call premium to pay for the insurance. Now, of course, there's an upside and a downside risk to all this stuff. We cover that in the PDF report. But that's an example of why the PDF report has value. And here's the final thing. I'll give you one other thing. You always hear unusual options activity, right? Unusual options activity. Okay. Well, there's a way to do that and play with that allows you to buy an option and speculate with all the unusual activity, but do it at a different strike price that's being announced on TV or being announced on the website that is showing you that there's when you notice there's unusual activity in a strike price. There's a way to play that where you take a different strike price and then you can leg into a spread, and then basically maybe have a spread that has no cost in it to you and a nice big potential gain. And that is something that we can talk about as well. And that is different ways of playing unusual option activity. But we're coming to the top of the hour now, so I'm just going to wrap up. And basically, I'm wrapping up by telling you this. I got a lot of experience and knowledge, and there's no doubt about that. And I've tried to do our best to come up with 5 PDF reports that have value to you that you can pick up. And here's the kicker. People who pick up the PDF reports, again, it's not a newsletter you have to buy every month and they're telling you the same lousy stocks and the stocks are down 50% and they're still nailing your credit card. That's not the game here. This is a one-time deal. And then if you want other ones, you can get them if you'd like. But they come with a 20-minute Q&A with the option professor. So if you have questions, again, we can help you with as best answers as we have. We'll share our opinions and our observations. We are not giving advice because that is for your brokerage firm and yourself who know your financial circumstances, not us. We have information that we believe is good information. It's our opinion, right? It's our opinion. Our opinions could be wrong. Our observations could be wrong, but we have the right to give them to you and we're going to give them to you. And it's based on our work and our experience. Now, if you need advice, you go to a broker, you go to your advisor, you go to whoever those people are, okay? Because this stuff is not right for everybody. And obviously, we have no idea if it's right for anybody because we don't know their circumstances. So do consult your broker and your brokerage firm, okay? But these PDF reports, in our view, add value, and being able to ask questions to somebody who has a lot of experience may add value as well. You make that determination. Okay. Now, optionprofessor.com. That's where you go. Option Professor, OPTION PROFESSOR.com. Put your information in there. Let us know you have an interest, and then we'll give you the details on how to get the PDF reports and, of course, how you can get a Q&A. If you want to email us at the email address, it is optionprofessor@gmail.com. Okay. There's a lot to cover here, guys, and I tried as much as I could. I can only briefly go over. I can't go over everything we've got. But again, you want to do things with your money, you're trying to get income on it. You're trying to get growth and value. You're trying to get international exposure, possibly. You want to look at some of those speculative areas, and you want to know about hedging. These are the reports that we have, and that's what we're basically asking you to get. So again, optionprofessor.com or optionprofessor@gmail.com. And we will hopefully hear from you. And then, of course, with Timing Research, we'll be around and be more than happy to talk to you down the road and update you on our views and our opinions. Right now, this is Option Professor going to sign off, wishing you all a good day and also a good week and good luck and good trading. Have a great day, everybody. Look forward to hearing from you. optionprofessor.com.